Hello traders, let me teach you some things here. One of the things is external liquidity sweep, and the second thing is internal liquidity sweep. And what do I mean with external liquidity sweep? Let's start with the word liquidity. Liquidity means money. In the simplest form, you should know liquidity as money. When it comes into forex, we all involve our money while trading forex, meaning that there is a lot of money circulating in the market. So when I say external liquidity sweep, this is the money that should be swept on an external range of market structure. And when it comes to internal liquidity sweep, that's the money which should be swept on an internal range of a structure. So to cut the story short so that you can understand, let's go on this market. This is Euro AUD and we are on 4-hour time frame. So what I was meaning by structure is something like this. Like for now, this type of trend, we are on a downtrend. We are coming from up to down. We are going bearish. When we say a structure, it's what forms this downtrend. And as we know, a downtrend is formed by lower highs and lower lows. So all these series of low highs and lower lows, they are the ones that form a downtrend or a bearish market. So we want to see this structure here. Like here you see price came and blocked that zone. Meaning that when it blocked this zone, it formed another lower low here. And after forming this lower low, the market came up, then it broke on this zone, forming another break of structure. Meaning that the price is breaking this structure. Comes and breaks here, it forms a lower low, it goes up to form a lower high, it breaks down to form a lower low, and so on and so forth until we go down up to when the market changes its order flow from bearish to bullish. So this market here is on a bearish order flow. Everything is flowing down. So we are on a bearish order flow. So when we say external liquidity sweep, in short terms, let me tell you, if you don't know where the liquidity is residing in the market, just know you are the liquidity. The market don't go like how we take this concept like if you are going bearish, you go bearish. No, there's something we call liquidity. And this liquidity is in form of buy stops and stop loss. So when you place your stop loss somewhere, assume you waited this market to come and retest this bearish trend so that you can sell, meaning that you would have placed your stop loss right above there, then you place your sell order, meaning that your stop is right above here. That's the liquidity we are talking about. And the market don't leave liquidity behind, and even if liquidity is left behind in future, that liquidity must be swept, or the market will come and form a liquidity zone there so that the market could reach another higher level or another lower level. So we see the market breaking this zone, going down. So when the market broke this zone, it went for the external liquidity, and after breaking, it has to come for the internal liquidity. And that's why you see the price came back onto this zone to sweep liquidity for this structure. You see this structure from there up to here. It's a bearish trending move. This is a bearish move, meaning that there was some liquidity which was left behind. So the market had to come back to clear the liquidity so that the market could go down like this. So the market came in to fill in some liquidity so that the price could go down. And if I put my Fibonacci tool here, you can see that, you see, the market retraced more than 50%. And on ICT or smart money concept, we call this zone above the 50% of Fibonacci level, we call it premium zone, and below it, below the 50% level, we call it discount zone. So when we are going down, the market has to retrace on the previous structure. It has to retrace it on above 50% level, which is premium. Then if you are going up, the market should go vice versa, should retrace down up to the discount zone before going up. But now on this market, you see the market reached this level here, this zone, making sure that it has swept liquidity on this structure before the market going down. I hope you understand this. So let me delete this box. So the market already reached premium, then went down. Now we are left with this zone. When the market came, it broke even this structure here, we formed a break of structure. This is a break, that is a break of structure. This was the previous break of structure. Now we want to see price coming to sweep liquidity on this internal range. And how should it happen? We want to see the price coming onto this zone, and it has to retrace above 50% of Fibonacci tool, which we are saying it's a premium zone. Let me put the Fibonacci tool again here. So we have to see the price coming onto this zone so that sweep the internal structure liquidity before the price going down. So, and how should you know where exactly the price should come? Though we have already known that when you are going bearish, the price has to come on premium zone. But now you want to know exactly how it happens before going down. Like now, there's something what we called order block, and I can see an order block on the premium zone, because this from this 50% level going up to 100% level here. This is the premium zone. So we want to see market coming to sweep liquidity, and here I can see an order block, because order blocks are one of the things which will make you understand where the liquidity is residing. The other thing is fair value gap, and below this order block we can see here there was fair value gap which was left here. I pressed just a small Fibonacci level because the price always comes to mitigate a fair value gap up to the 50%. That's where we should press our sell order there. That's where the liquidity should be swept up to, because liquidity is swept either on the fair value gap or at the order block. So you have to wait for the price to come back to this fair value gap or to the actual order block. That's where the market should retrace before going down, because we are still on the bearish move. Now we want to look for an entry. So you should expect the price to come on the 50% of the fair value gap or on the extreme, because you are not exact where the market should come to retrace. What you should do, put your sell order on the 50% of the fair value gap, and you should place your stop loss right above the order block. Then you should target the extreme external liquidity, because we are going for internal liquidity, then we go for external liquidity. So you should target extreme end of this structure so that you can reach the external liquidity of this bearish trend. Let me still show you counter trending. Let me remove this one of the tools here. Let me show you how to counter trade this market. And counter trading is that you can buy when the market is going down, though you are not fighting against the trend, you are only counter trending. It's called a counter trading or counter trading. So let me show you how to counter trade this type of market. So what you should wait for is a break of structure. So let's see how the market behaved here. The market came down, then it started coming up, and it formed and by this you see it has formed another liquidity zone here by forming this double bottom. Let's continue and see. Boom. You see now the price, our aim is to see the price coming to the premium zone, then going down. Now we have seen that the price has already broke this high here. You see, meaning that the market is now ready to buy. Let me show you how liquidity is being swept. All the traders sold on this zone because it was the actual downward trend. previously the price was respecting this trend line, so there was high chances that most of the retail traders sold on this zone. If you use smart money concept, you wouldn't have sold here, because you see there is pending liquidity here up, which must be swept in future, so you wouldn't have sold here. But actually it was a trap for all many retail traders to sell at this point, where the market came and formed here liquidity zone, meaning that it has collected a lot of liquidity. Now it is time to come for your stop losses. When you see any retracement move forming on a certain trend, like here, there's some stops here, another stops here, another stops here. These stops are your stop losses. The retail trader stop losses are all deciding on these tips. So meaning that the market has left a lot of liquidity behind, and it might end up on a consolidation if it moves that way, and the market can't leave liquidity behind. So the market has to fill the liquidity first, then push down or push up. Now you see here there is a break of structure, meaning that the market is ready to come and sweep the internal liquidity of this structure, all this downward move. And after breaking this structure here, let's see how we can counter trend this move up to this zone. Then after the market sweeping the liquidity on this zone, we continue selling. You see, after this formation, the price has to come on this structure to sweep some internal liquidity so that it can have some fuel, because the liquidity is the fuel of the market, to get the fuel to push up. So if you want to counter trade this, you should come on this 50% level. Let me delete this first. Yeah, my screen. Now you see, because we say that the price, if you are going up, the market has to come to sweep liquidity on this internal structure, and it sweeps from below 50%, which is discount zone, when we are going bullish. But when you are going bearish, it sweeps on this zone above 50%, which we said it's premium zone. But now, because we want to go up to this zone to sweep the liquidity above this structure, this old structure here, we have to wait for price to come and sweep some internal liquidity here before going up. And how should we know where the price should reach before going up? You should look for the institutional reference points, and on this case there is this order block here. You see this red candlesticks here, the red candlestick, that's one of the institutional reference point, that zone. So you should expect the price to come and retrace on this zone, then going up. And how exact are we? Because the first thing, there is an order block below 50%, which is on discount zone. To qualify for another factor that this is the order block which the price must trace from, it has a fair value gap on top of it. So that's the second confluence, and this is it here. That's the fair value gap. So if you want to go up, the fair value gap is between these 2 wicks, because the fair value gap is formed by 3 candlesticks, but the 2 candlesticks of these 2 candlesticks shouldn't mitigate each other, meaning that there is a gap here which should be filled, and that's what we are calling a fair value gap. So we should wait for the market to reach this zone, and as I told you, like here, we are waiting for price to come and it is on 50% of this fair value gap, then we go down. The same case applies here. We will have to wait for market to come and retrace on this. Let me delete this rectangle and I put a Fibonacci tool so that we can see where the 50% is, like that. So the price has to come in between these 2 lines here. This is the 50% zone, and that's where you should put your buy order. Then your stop loss should be just below this order block, some pips below. Then you should target the internal liquidity, where we said it's on this 50% fair value gap. Then target your profit there, and you see that zone can give you a 1:3.43 risk reward ratio. Let's see how the market behaved. Let's see, the price came up, then it tapped on our fair value gap, then market went up. You see where the market tapped, it retraced the order block and it filled this fair value gap, then price reversed from that zone going up. Let's see, boom. Have you seen how the price behaved? Now I told you you would have put your short position here, then you place your stop loss right above this order block here, then you target on the external liquidity, and in this case, because we are going bearish now, we have finished counter trending this move. Now you should expect the market to reach the external liquidity of this structure now, because we have swept the internal liquidity of this structure. Now we are aiming to go to get all the liquidity which was left below this zone. You see below that blue line I've drawn, there is a lot of liquidity here, because even when we bought, we left our stop losses here below, meaning that our stop losses can be victim of the liquidity sweep when the market is coming to sweep the external liquidity here. So you should target from this zone, you should target the external liquidity, and it's on this zone just there. You can still gain a 1:3.6 risk reward ratio, which is a good return. And let's see how the market distributed the liquidity now. Let's see, let's give it time, let's give it time. The market is still pushing, still consolidating. Then you see the price distributed the liquidity, it utilized the liquidity very well, and it is reaching out on the external liquidity now. As you can see, let's see if we would have got some profit from this trade. Let's see, we have to reach the external liquidity here. Let's see, you have to be patient enough. Boom. You see, finally the price came. That's for today, traders.